Nearly half of Americans don't have a written financial plan. At the same time, we see viral charts saying average 50 or 60 something has hundreds of thousands of dollars, sometimes even millions, saved for retirement. If you're in your 40s, 50s, or 60s, that can leave you wondering, am I behind or am I actually doing okay and I just don't know it? So in this video, we're going to look at the median, the average, and even the top 10% net worth of your age group. And whether you're still catching up or already sitting on a 7-figure or multi-million dollar portfolio, I'll show you the specific levers that matter at your level. Hi friends, welcome back. I'm Diane. I'm a wealth strategist helping busy professionals and families build wealth, balance life, and create a prosperous future for their families. I spent over 15 years in finance and consulting, advising everyone from the World Bank to private equity firms to family offices and individual investors. In this video, we're going to first look at real net worth numbers for your 40s, 50s, and 60s, median, average, and top 10%. Talk about what those numbers actually mean for you, instead of just throwing some random stats on the screen. Next, walk through clear moves you can make in each decade, whether your next step is catching up or optimizing what you've already built. This video is about giving you the clarity and confidence to make better decisions for the next 5 to 10 years of your life. Before we dive into the charts, quick refresher. Net worth is what you own minus what you owe. What you own, homes, retirement accounts, cash, investments, business equity, minus what you owe, mortgage, student loans, credit cards, car loans, or other debt. Now, if you haven't tracked your net worth before or just want a simple template, I've put a net worth tracker in the description that you can download and use today. The data we're using today comes from the Federal Reserve Survey of Consumer Finances and tools like Don't Quit Your Day Job, which breaks the data down by age and percentile. And some key definitions. Median is the middle households, half have more, half have less. Average, pulled by very few wealthy individuals or households. And the 90th percentile, roughly the top 10% in your age bracket. These are reference points, not a report card. The goal isn't to hit a perfect target, it's to understand where you are today and what levers make sense to pull from here. So grab your coffee and let's dive in. If you're in your 40s, this is the decade of peak juggling. Career, kids, housing, maybe aging parents. Recent data suggests that the median net worth in your 40s is around 70 to 80,000, while the average jumps all the way over 700,000, pulled by higher net worth households. For the top 10%, net worth often starts in the low 7 figures, around 1.2 to 1.5 million. If you're near the median, that's more common than you think. The better question then, why am I not at the average, is, where do I want to be in the next 10 to 15 years, and what can I control now? If you're between the median and the average, your choices this decade will largely determine whether later life feels tight or flexible. If you're in that top 10% band, the question becomes, what's my actual plan? How do I structure this so it supports my life and not just sit on a statement? The highest impact levers in your 40s are quite simple. First is to lock in higher savings rate when your income goes up. So instead of letting every raise disappear into lifestyle, decide that a slice, say half of every raise or bonus, goes straight into retirement accounts or brokerage accounts. Now, here's a quick example. If you make $100,000 and you go from saving 5% to 15%, that's an extra $10,000 a year. Over 15 years, that's $150,000 of extra contributions before growth. Now, with even modest returns, that can turn into hundreds of thousands or more by your 50s. Second is to tackle high interest debt deliberately. If you're carrying credit card or personal loan balances in the high single or double digits, paying those down is like earning that rate on return guaranteed. A 21% card is a 21% return when you pay it off. This is also the decade to make a plan to clear as much non-mortgage debt as you reasonably can. Big student loans, personal loans, lingering car loans. So more of your 50s income goes towards compounding for you instead of paying for the past. Next is to invest in long-term money for growth. For money you truly won't touch for 10 to 20 years. It usually makes sense for a meaningful portion to stay in diversified stocks investments rather than cash. Broad, low-cost index funds like an S&P 500 or total market fund quietly compound in the background. Your job is to keep feeding them and avoid panic selling when headlines get noisy. Now, if you didn't set up automatic systems in your 30s, your 40s are the decade to get clear on your system. What comes in, what goes out, what gets invested, and what are your short to medium term plans. You may be also approaching peak earning years, 10 to 15 years into your field. So it's worth asking, what are my unique skills and how can I use tools like AI or specialized expertise to increase my earning potential? I believe there's a limit to cutting, but there's a far less limit to sustainable earning. The sensible next step in your 40s doesn't have to be dramatic. Write down your major assets, your major debts on one page. Focus on moving the biggest needles, not obsessing over $5 lattes. Then choose one concrete move. Either slightly increase an automatic contribution or commit to a fixed extra payment towards your highest interest debt. Your 40s are about building the engine so that your 50s and 60s are about options, not struggle. Now, this is exactly the work that I do with people I've partnered with. So if you're 40 plus, 50 plus, and 60 plus, and you want help turning your numbers into a clear, personalized roadmap, I'm offering free clarity calls where we can walk through your freedom number and the specific levers that make the most sense for your situation. So you can walk away with a strategy that is tailored to you and not generic. Now, if that sounds helpful, you can book a clarity call with me in the link in the description box below. By your 50s, the stakes and the potential both get bigger. The median net worth is around $190,000, while the average is well over $1.2 million. For people that are in their top 10% net worth, often sits between $2 to $3 million range. The spread between typical and top gets wide here, which is why so many people in their 50s feel either quietly confident or quietly anxious. Now, if you're below or around the median, small casual changes usually aren't enough. The math often points towards like a higher savings rate, potentially working longer and being intentional about risk so that your money can grow. Now, if you're between the median and the average, your outcome will heavily depend on what you do in your peak earning years. Now, if you're in the top 10% zone or already in the seven figures, the priority shifts from, do I have enough, to, is this structured well? Am I tax smart? Do I have an income plan? The main levers in the 50s basically fall into three buckets: contribution room, tax structure, and risk level. So first is contribution. This is the decade where the IRS explicitly lets you catch up with higher contribution limits in workplace plans, IRAs, and often HSAs. Directing raises, bonuses, and basically any money windfall into these catch-ups is one of the fastest legal ways to move your trajectory over the next 10 to 15 years. Second is tax. Many people in their 50s have most of their savings in pre-tax accounts like a 401k or a traditional IRA, which can mean a heavier tax bill later. Building up some Roth exposure, Roth 401k, Roth IRA, backdoor Roth, where appropriate, and some taxable investments gives you more flexibility when you decide how to draw income later in life. For higher net worth households, this is where asset location, Roth conversions, and tax smart giving, things like donating appreciated stock, using donor advised funds, or later qualified charitable distributions can materially reduce taxes over time. Next is your risk level. You still need growth. Your money may need to last 30 to 40 years, but you have less time to recover from a big drawdown. Think in terms of time horizon. Money you'll likely need in the next 3 to 5 years leans more towards cash and high quality bonds. Money you don't need to touch for 10 plus years can stay more in equity heavy things. You want to treat your 50s like a systems tune-up, not a crisis. Look at how much you're contributing now versus the limits and pick one change you'll commit to for the next year. Sketch out where your money lives, pre-tax, Roth, taxable, and notice which bucket is light. Then scan your investments and tag each pool by when you expect to use it, adjusting the mix of stocks, bonds, and cash so that near-term money is buffered and long-term money can grow. Your 50s are about using every tool, catch-ups, tax buckets, and calibrated risks to turn your highest earning decade into actual freedom later, not just bigger balances. Now, in your 60s, the question shifts from how big is my net worth to can this support my life and will it last? The median net worth for someone in their 60s is around $290,000 and the average is well over $1.5 million. The top 10% are boasting over $3 million or more. So is $190,000 enough? In a high cost city, probably not. But if your home is paid off, you're willing to work longer and open to living, let's say, a more frugal or lower cost area, that number can stretch further than it looks. So the question isn't just, is this enough? But what levers do I have? And what trade-offs am I willing to make? Now, if you're around or below the median, you might need to be more conservative and creative, working longer, spending less, considering a smaller home or different location, or using home equity carefully. Now, if you're in the middle range, a lot depends on whether you turn your nest egg into a deliberate income strategy instead of winging it. Now, if you're in the top 10% with a multi-million-dollar portfolio, your main risks are tax drag, poorly timed withdrawals, concentrated positions, and no clear healthcare healthcare, or legacy plan. So a quick example of how small decisions can add up. On a $2 million portfolio, a 1% difference in fees and tax drag is over $20,000 in year one. Over 20 to 25 years, that difference can easily compound into hundreds of thousands of dollars, purely from how efficiently you invest and withdraw. So the main levers in your 60s are protection, planning, and pacing. The first is to guard against sequence of returns risks, a big market drop right as you retire. So setting aside several years of expected withdrawals in cash and high quality bonds can help you avoid selling stocks at the worst time. Second is planning, turning a pile of assets into an income map. Estimate your annual spend, list your income sources, Social Security, pensions, rental income, part-time work, portfolio withdrawals, and decide which accounts you'll tap first and how fast. For a good number of people, starting with 3% to 4% withdrawal range and using tax-aware sequencing, taxable, then pre-tax, then Roth, is a pretty reasonable framework. Next is pacing. Be intentional about Social Security and healthcare. When you claim Social Security, you can change your lifetime benefit in healthcare, Medicare, supplemental coverage, potential long-term care can materially affect how long your money lasts. A sensible next step in your 60s is to get out of your head and onto paper what it costs to live a normal year, when each income source kicks in, and how much you might safely withdraw from your portfolio. Then you want to check if your current investment mix supports that plan. Do you have a buffer for safer assets for the first several years and enough growth to keep up with inflation, let's say over a 25 to 30 year retirement plan? Now, if you're in higher net worth, this is also the time to be very intentional about tax-aware withdrawals, charitable givings, and legacy goals so that your money reflects your values. Your 60s are about turning your net worth into a reliable, values-aligned income plan, not letting a single number dictate how you feel. Now, we've talked about the median, the average, and the top 10%, but none of those tell you what you actually need. A family that wants to travel often and help adult kids will need a different target than someone who prefers, let's say, a more simple lifestyle in a low-cost area. So instead of, let's say, chasing after someone else's number, whether it's 1.2, 1.8, or 500,000, 700,000, you want to work towards your own enough number, a range that can support the life that you want. So first, you want to start with your real spending and the BCA framework. Basic, comfortable, aspirational. Look at what it costs to live in a normal year: housing, utilities, groceries, transportation, childcare, and if that still applies, healthcare, travel, and the smaller things that matter. Then put it into a 3-part framework. Basics, your must-haves, non-negotiable, a comfortable life, stable, relaxed version of your life. Aspiration, let's say upgrades, generosity, and experiences you'd love to layer on. You don't need to have a perfect budget, but you need to have some type of realistic range. Now, I've created a BCA worksheet to walk you through this step by step so you can see it in black and white what basic, comfortable, and aspirational look like for your life. The link is in the description box below. Now, once you've sketched those numbers, you can use a simple 3 to 4% withdrawal rate to get a ballpark nest egg target. Now, very roughly, if your comfortable lifestyle, let's say, is $60,000 per year after Social Security and pension, you're thinking the ballpark of 1.5 to 2 million in investable assets, depending on risk, other income, and flexibility. Now, if Social Security, rental income, or part-time work can cover part of that, your portfolio doesn't need to do as much of the heavy lifting. So the point here isn't total precision. It's moving from foggy to this is the range that I'm aiming at. Now, when you compare that rough range, or when you compare that rough enough range to where you are today, treat it like information, not a verdict. If you're below your comfortable or aspirational target, it just means that the levers we've talked about, higher savings, catch up, smarter tax brackets, calibrated risk, matter more, and working longer or adjusting lifestyle might be part of the mix. Now, if you're close or above your enough range, the work shifts from how do I get more to how do I protect this, make it tax efficient, and design a life I actually want. Friends, if you made it this far, thanks so much for watching. I know talking about net worth can bring up a lot of comparison, worry, even regret, but you're here, you're paying attention, and that alone puts you in a very small group. Now, if you found this helpful, hit that subscribe button and share this with someone in their 40s, 50s, or 60s who's wondering if they're behind. Now, if you want to go deeper, you can check out my next video here on how to retire in the next 7 to 10 years. I'll link it in the description box below. You don't have to have it all figured out today, but you can get clear, make a plan, and start moving one smart decision at a time towards a work optional life that actually fits you and your family. Friends, thanks so much for watching, and I'll see you in the next one.